Okay, good evening, folks. This is the UK House Price Index according to Zoopla for August 2023. This is quite interesting reading because out today as well, Nationwide had their house price index out today, and they're saying house prices fell by 0.8% month on month to August, and house prices are now 5.3% below August 22 peak, and representing an annual fall of 14,600 on a typical home. It's quite interesting because I don't, everybody follows Nationwide, the news report Nationwide and Halifax figures. But remember, their figures are only based on their mortgage holders. And yes, they have a substantial amount of them, but they don't actually correlate strongly to Zoopla, who has a whole of market, obviously, because they've got all their estate agents listing property on mostly all over the UK itself. So they get a bigger picture or a more fuller picture of what's actually going on in terms of how the Nationwide looks at it as well. So I'm a big believer of following the Zoopla pattern house price index rather than actually looking at Nationwide. Nationwide tends to paint doom and gloom, so does Halifax. Whether that's actually factually right or not is another question. But I've never had it come to fruition that the Nationwide has actually been right in their figures, put it that way. Okay, so let's talk about the house price index for Zoopla. So the executive summary for Zoopla themselves, they're actually saying annual UK house price inflation slows to 0.1%. So it's the lowest since 2012, according to them. House price growth ranges from 1.7% in Scotland, that's a plus, to minus 1% in London. They also go on to say that the profile of regional house price inflation linked to first-time buyer affordability and the relative cost of renting and buying. So there's a link there between the price inflation and also first-time buyer affordability to the relativity of cost of buying or renting. This is actually quite interesting because we're going to cover that right here. Housing transactions still on track for 1 million by the end of the year for completions. So right across the whole of the UK, sales completions, they are 21% lower though than over 2023, the lowest level since 2012. Now, I talked about this before. It's not necessarily house prices that show the health of the property market overall. It tends to be the number of transactions. So what we want to see is stability in the transactional levels, and it's going to be 21% down. But if it is 21% down, it does show we possibly have a limited supply of stock, which actually supports the house price itself. Hence the reason why they've only got a 0.1% plus, and Nationwide turns around and says, but we've got a minus 5.3 year on year. So that's why the difference in disparity. They look at it on a whole basis, currently what's on the market right now and what's actually completing and what they're completing for against what's on the index from the land registry. So they go on to say as well, Zoopla cash buyer sales expected to hold in line with 2022, which is good news, while mortgage-backed sales likely to be 28% lower as higher rates impact demand for mortgage holders. This is the higher rates and base rates going up. It's making mortgages less affordable to people at the top end of the market in terms of price point. However, they're probably choosing to buy a property at a lower price point because of affordability. Remember, we move primarily for our circumstances are actually changing. In other words, our kids leave home for university or they leave home to have their own house. Therefore, the house is too big, so we go to downsize. And we have children, and we have an extended family. We have to upsize as a result of that. People go their separate ways. Therefore, they have to sell the main house and they each buy two separate properties individually for themselves. People actually get together for the first time and they buy a home together as well. So it's the circumstances that drive the housing market. It's not necessarily the fact that, I could make money out of the houses. That's only really primarily for an investor, I would say, which is about 94% of investors in Scotland, for example, have only one property, 5% have two properties, and 3%, and 1% only have three properties or more. So very, very limited in terms of the number of properties every investor has. Most have just one property overall. Faster earnings growth improving housing affordability. So in other words, earnings are actually going up. They're going up 7.8% in the year on year, according to the statistics from the government. And so and if you add in bonuses for NHS, they've gone up to 8.2%. So they're actually going up. Therefore, they're supporting affordability levels as well. So it actually helps the housing market overall. Lower mortgage rates as well are key to improve demand and sales in 2024. That's what Zoopla finally goes on to say. So let's look at what the graph I've got here. This is it here. So this shows you overall. Let's just go through this. This is demand. So demand and sales running below 5-year average. So this is against the 5-year average. So it's 34% below the 5-year average demand. The number of sales agreed is 20%, as we'd said before, below the 5-year average. Flow of new supply is 9% below the 5-year average. Now, flow of new supply is 9% below, therefore it supports the market to say that there's less properties on the market, therefore it probably supports the house prices themselves from actually falling significantly. Stock of new homes or stock of homes for sale has actually gone up 16% compared to the 5-year average, which is probably good news. We don't want too limited stock, because then we have another mini boom itself. So what do they go on to say then? Well, higher mortgage rates. High mortgage rates weigh on the market activity overall. The housing market continues to adjust to higher mortgage rates and cost of living pressures with weaker demand. Fewer sales and very low house price growth. It's a slow and drawn out process, exacerbated by the seasonal factors, which is summer, spring, autumn and winter. Market activity continues to track in line with 2019 levels, but remains well below levels of activity recorded over the most recent pandemic years. Looking at the last 4 weeks, Zoopla says the leading indicators show demand for homes is running 34% lower than the average compared to the same period in the last 5 years, from 2018 to 2022. So they go into then again say sales agreed are down to a lesser degree, so they're down by 20%, as the availability of the homes for sale has rebounded after a period of scarcity. So in other words, what they're trying to say, and here is the indicators for demand for homes is running 34% lower, but the number of homes actually completing is only 20% lower. So there's still a good demand out there for certain types of homes. More than likely, we've looked at this before, annual and it's technically it's probably everything up to about 250 to 300,000 actually sells quite well. Everything after that starts to peter off in terms of the demand for it, because affordability becomes more difficult for people. It require mortgages to have that. So let's have a wee look at the graph here we've got for the areas. This is over the areas, Scotland, Northeast. So this is Scotland, Northwest as well of England. This is also, when we look at it as well, it's the West Midlands, Northeast, Wales, East Midlands, UK. So UK overall 0.1% improvement. You can see Scotland's 1.7%. So Scotland is actually doing the best according to Zoopla out of all the areas in terms of house price growth. So they're still very, very buoyant in terms of their market. But the ones that are suffering is Southwest, Southeast England, Eastern and also London. No surprise. But remember, it's only a 1% drop year on year according to their statistics for Zoopla. And you know, I think they're a good measure, a good barometer of what's going on in the UK housing market overall itself. So they go on to say then southern regions register the largest price falls. Weaker demand, more price sensitive buyers, and fewer sales have led to a rapid slowdown in the house price inflation over the last year. So annual UK house price growth is at 0.1%. And it's really a virtual standstill, I suppose. And this is the lowest annual house price growth for actually 12 years, since August 2012. But that's nothing to worry about. Just when we say, we'll almost say it as if it's negative. This is the lowest annual house price growth in the last 12 years. Okay, is that not what we want? Just average house price growth. We don't want anything like a boom market. We don't want anything like a negative market. We want it to be, you know, reasonably, probably 1 or 2% every year. So that's actually quite a good thing to have it right like this, because it's a balancing for the last 30% jump we've had over the last 3 years overall. There's a clear north-south divide in house price inflation. All regions across England are registering year-on-year price reductions of up to 1%. Other regions in the countries and in the UK are posting single-digit growth, like Scotland, for example, at 1.17 in terms of its growth. So they go on to say, Zoopla, actually, this pattern of price changes reflects the greater impact of the higher mortgage rates on the higher value of housing markets. In other words, affordability of mortgages when the price is a lot higher. So buyers in the southern England need larger mortgages, as we've explained, bigger deposits and higher incomes to buy. This effectively prices more buyers out of the market for that reason. So it weakens the demand and also it pushes down prices in these areas because therefore it demands less and you've got more supply. It's a supply and demand situation where possibly it's turning into a wee bit of buyer's market in the southern regions of England and London. So activity and holding up better and more affordable markets, and particularly they go into, say, Scotland. These trends will continue over the rest of 2023 and into 2024. So prices are actually holding up where first-time buyers can actually still buy. That's the great thing, and I think that's where the affordability is for Scotland overall. So what can I say about that? Let me just say, Zoopla then goes on to believe that variation in house price growth across the UK is partly explained by the ability of first-time buyers to buy at higher mortgage rates. First-time buyers actually account for 1 in 3 sales a year, so 33% of the market right now, most of whom originate from the private rented sector, which is good news because then they come out the private rented sector. Therefore, they release another house for somebody that needs it in the rental sector, and they go on to buy as well. And that keeps that natural cycle going. This means that the dynamics of renting and buying will impact on demand and prices. So lower mortgage rates over the recent years made mortgage repayments for buying much cheaper than renting. So it made a mortgage a lot cheaper than renting. But remember, a mortgage is the least you'll ever pay for a house. Renting is the most you'll ever pay for a house because you don't pay for any repairs or improvements in renting, the landlord does. Whereas a mortgage, you have to pay for your own repairs and improvements for having that. Plus the fact you have to pay for your entry and exit costs in terms of buying and selling and legal fees as well. Whereas renting, you don't do that. You can just deposit first month's rent up front. When you leave, therefore, you pay your rent up to the point that you're due, and then you get your deposit back if you looked after the property. It's as simple as that. So it's an easy exit and entry premise for the rental market. So they've both got really pluses, and then it's the swings and roundabouts about which one's best for each person. So we're going to go on to talk about that, and Zoopla talks about that as well. So this is supported by first-time buyer demand and led to many more first-time buyers to buy three-plus bedrooms homes, bypassing the market for flats and smaller houses, which means this will mean if they're bypassing the flats market and the smaller houses market, as base rates continue to go up, these houses and flats will become more in demand. Therefore, they'll probably increase more in value over the next couple of years in comparison to semi-detached and detached houses. Proportionally, that means, in other words, percentage-wise. Because obviously a detached house is sitting at 350,000, whereas a flat's about 126,000. So 10% of a flat is 12,000, whereas 10% of a detached house is 35,000. So, but 20% of a flat is probably about 24,000. It's nowhere near the 10% of the semi-detached. So see what I mean? So the percentage will jump higher for the flats and for the smaller houses, but it won't jump as high for the detached and semi-detached properties. So let's jump back to this. So Zoopla goes on to say mortgage rates of over 5% have now reversed this trend. The national average making renting 10% cheaper than buying at the UK level, despite high growth in rents in recent years. So Zoopla is actually confirming that it's 10% cheaper to rent than it is to buy now a house. So you might find a lot more people actually considering using rented accommodation because it's easy entry and exit, and also the very fact that it's the most you'll ever pay for a house because it's your rent. All the repairs and improvements are done by the landlord. However, let's look at the graph for this, and it will show you by regional basis. zoom in this, and here we go. Okay. So here we go right here. This is the graph, and you can see Scotland. So buying cheaper than renting in 6 areas at 5.6% mortgage rates, this says. So in Scotland, it is actually the average rent is 748, the mortgage repayment is 620. So it's actually on this, on the face of it, it looks like it's cheaper to buy than it is to rent. But remember, you've got to factor in improvements and repairs into that 620. So you've got a differential there right now between buying and renting of £128 a month. So £128 a month is round about 14, probably, probably about 14,000 a year, I think that is, or thereabouts. So about 14,000 a year, £100, no, 1,400 a year, £128 a month. So therefore, you've got to factor in, do you think you're going to pay more than 1,400 on your house? And improvements or repairs over the year, plus the fact you've got the how long you're going to stay in the house, which could be just 2 years. Therefore, you're going to have to pay for the legal fees to buy it, and then you're going to have to pay for legal fees to sell it, and you're going to have to pay an estate agent to sell it as well if you're no keeping it, and then you move on to your next house. So therefore, if you measure that in the 2,400 extra you would pay between buying and renting, the 2,400 is probably just the legal fees for buying and selling without even taking the estate agent fees and repairs and improvements into account. So still, on the face of that, on the face of it, with these two numbers, it looks like renting is actually less attractive than buying in Scotland, when in actual fact, if you look at these other factors into account, renting is actually quite a favourable option if you're not staying in the property long term. But the highest areas that they're saying here is North East England, North West England, Northern Ireland, Yorkshire and Humber, and Wales. And then it starts to drop below, where it makes it more worthwhile to actually rent than it is to buy, because the mortgages and affordability in the West Midlands, East Midlands, the Southwest, the Eastern and the Southeast and London are far greater than actually renting. So it's preferable to rent in these areas in comparison to buying, because the prices are astronomically high. So what is Zoopla going to say about that then? However, the experience of would-be first-time buyers varies across the UK. A renter buying a home where they rent would find it cheaper to buy than rent in the 6 regions of the countries in the lowest areas. In Scotland, the North East, average mortgage repayments are up to 18% lower than rental cost, but then you've got to factor these into account. This supports access to housing market and the demand for homes. And in contrast, it's more expensive to buy a home and the rent all across the southern England and the Midlands as well. In London, the average monthly payment is 24% higher than actually renting for a mortgage. So it doesn't make it an attractive option possibly to buy in London at all. So mortgage rates and one are pricing for more first-time buyers out the sales market across England, and reducing demand and compounding the downward pressure on house prices. Actual position is worse, they're going to say Zoopla, for all first-time buyers, when allowing the fact that the mortgage lenders require new borrowers to be able to afford higher mortgage stress rates closer to 8.5% rather than the product rate of 5.6%, which they're actually getting at using this analysis. This reinforces Zoopla's view that the price reductions will remain concentrated across southern England, where affordability challenges are the greatest. That's the price reductions. So southern England will see higher price reductions than actually Scotland overall. So we see Scotland's a very, very stable market, and particularly as well in our region, which is Fife. And other regions of Scotland as well. Okay, lower house prices and mortgage rates are needed to stimulate demand and sales overall. They're on track, according to Zoopla. They're on track. We're on track. UK sales for 1 million completions. That will be down 23% on the 5-year average. So house price growth has slowed rapidly over the last year, and primary impact of higher mortgage rates has been lower sales volumes. So the higher mortgage rates has led to lower sales volumes as demand drops. Their data for Zoopla on the number of homes being sold subject to contract over the year to date shows the market is still on track for 1 million sales completion in 2023. This will be 21% down on 2022 levels, and the lowest number of sales since 2012. And that's equivalent to the average household moving every 23 years. So the average household, according to Zoopla now, moves every 23 years, according to these numbers. That's really surprising because I remember years and years ago, maybe about 20 years ago, the average household moved within 6 years and 7 years. So Zoopla is painting a totally different picture. Here's a nice wee graph to demonstrate this overall, where they see the number of transactions. So we can see in 1973, you can see there number of completions was just over 1 million itself. And in 1974, it was just under 1 million. And then it goes on, the highest peaks are number of transactions, about 2 million almost in 1988. And then you had that crash in the early 90s. That was a big problem. So therefore transactions dropped quite low. And then it started to spring up in the credit crunch. Just before that, about 1.5 and 1.6 million. And then 2008 dropped like a stone to round about 900,000. And we're just going to be over that slightly, but that's not anything to be concerned about because it's been about 1.3 for the last 3 or 4 years. In actual fact, when we look at the numbers and you look at the two booms that have just happened, it's quite consistent with the previous ones before the boom. And these were good markets at that time. So I don't think it's anything to be too majorly concerned. But Zoopla goes on to say that cash buyers hold steady as mortgage sales actually drop overall. So there's a lot of drivers out there, but the big driver of this reduction is fewer sales funded by mortgages as a result of higher mortgage rates. So based on trends over the first half of the year, and they estimate that car sales will fall just 1% over 2023, according to Zoopla, compared to 2022 levels. However, the number of mortgage sales is projected to be about 28% lower. And the net decline across cash and mortgage buyers is 21%. Now, this is what Zoopla says right now, but I personally think the banks are going to be more creative overall. I think the banks are going to be very creative in their mortgage lending. You can see that coming through because they're keeping their base rates, they're keeping their actual mortgage rates almost on the base rates level. So they're 5.6 for their mortgage, yet base rates is sitting at 5.25. And you kind of think, where do they make their money then? If the base rate's at 5.25 and they're only getting 5.6, there's not much in that. But what they're doing is they're doing 3% arrangement fees over a 2-year period for fixed deals and tracker deals and 5-year deals. So they're doing 3%. So if you put 3% over 2 years, you're actually adding on another 1.5% each year to that mortgage itself. So that's where they're making their margins in the higher arrangement fees, and they're adding them on. So they've been very, very creative in terms of what they're doing. They're also looking to move out their terms. So they're moving them possibly 25 years, and they're moving up to 35 years, which brings the monthly cost down by 20%, but it puts the overall amount you've got to pay back on that basis up by about 40%. But that's the swings and roundabouts, because within a certain period of time, you might earn more money, therefore you'll be able to pay down your mortgage quicker. Therefore, that term of 35 years might not be applicable. Therefore, you might actually pay a lot less than what you expect. But it's to make it easier in the short term for people to buy houses and keep the fluidity of that market going and the flowing of the market overall, the cycle, the natural cycle. So Zoopla then goes on to say existing homeowners using a mortgage typically account for a third of annual sales. So first-time buyers are a third of the market. Mortgage people typically account for a third of the market as well. So this group for mortgages, the third of the market, is under less pressure to move as they're already in a home, and where possible, will be waiting until the outlook for mortgage rates improves from its current levels right now. I personally think mortgage rates are maybe going to go up again in terms of the base rates. But again, we'll come back to saying maybe mortgage banks will, because you have seen them reduce them slightly, the overall mortgage rates. So you kind of scratch your head and think, well, if base rates are going up, why are you reducing your rates? Because they're loading it into the arrangement fees. So Zoopla then goes on to say the economics of new buy-to-let purchases are also being squeezed by higher mortgage rates. Mortgage buy-to-let purchases typically account for 8% of sales in the UK market. Buy-to-let investors in southern England need to inject 40 to 50% of the property value as equity to get the numbers to actually stack up, meaning new investment will be lower over 2023. While first-time buyer numbers will be lower in 2023, we expect them, or Zoopla expects them, to hold up as a result of more flexible working, opening up options to buy in cheaper markets as well as buying costs being lower than actually renting in more affordable markets, for example, like Scotland and the north of England. In addition, and Wales as well, Northern Ireland. In addition, more landlords selling previously rented homes are typically priced at 25% lower than the wider market, and that's actually boosting available supply, and that appeals to first-time buyers overall. So prices are holding up where first-time buyers can still buy, remember, as I said before. So let's go on and we'll talk about affordability as it improves, as earnings rise quickly in terms of that, and makes affordability really good for the market. And that's what we really want. If people still afford it, it keeps that going, that market. It's the transactions that are the most important one. It's not the house prices overall. There's a lot of equity built up in properties over all these years where people haven't been remortgaging. They've just built this equity up, especially over the last 3 years where everybody's jumped about 30%. So if you've had your house in year 4 or year 5 when you bought it, you've had a massive increase. So if prices drop by 10%, you're still up by 20. So it's neither here nor there in terms of where you are. If you're continuing to stay in it, it makes no difference at all. But if you're moving anyway and you're staying in the same area, you're trading like for like. So if you're trading up, you're obviously going to pay a bit more than the 10% drop, but you've got a 10% drop and you've got a 10% drop. So it's like for like, but you're paying a bit more because you're getting a better deal if you're trading up actually, because the 10% drop in that price is usually a lot higher to what yours is. If you're trading down, it follows the other way. Hopefully everybody understands that. If you're not very sure of that, please feel free to ask a further question, or if you're watching this and catch up with the podcast or that, please feel free to message us in, and I'll be able to answer a wee bit more on that for you individually based on your individual question. So housing affordability remains the primary barrier to more sales. Both the level of house prices and the cost of mortgage repayments are actually making that difficult. So the challenge is the greatest, and is the greatest in the southern England, and household income to buy a property remains about 75%, or at over 75,000 in many market areas. So in other words, they have to have 75,000 in income to actually buy a house in some of these areas in the southern areas of England. So higher mortgage rates increased the UK mortgage repayments by 23%, according to Zoopla, or £216 a month extra over the last year. So mortgage rates are starting to drift lower, but remain over 5%. Zoopla expects them to fall below 5% later this year, but it looks set to be a much drawn-out process as the financial markets reevaluate how much longer interest rates need to remain high to bring inflation under control. Any further improvement in affordability from lower mortgage rates is unlikely to impact on the market until the first half of 2024, I would say. So let's have a look at this. Here we go, house price to earnings ratio. So this is the graph here, and we can see there. So the red one is the house price. There's no surprise the red one is London. That's the highest house price to earnings ratio, and that's sitting around about 10 times earnings in the London area, which is okay. It's not, I mean, 6 times usually a normal market. And you look at the south of England, it's sitting around about the 8 times. If you look in the north of England and you also look in the Midlands, it's sitting around about 6 times. But the great thing is affordability in Scotland and Wales overall, because they're sitting around about, you would say, 5 times. Now, in Fife itself, in Scotland, I worked out it's around about 5.5 according to the UK House Price Index, and also the government's statistics about how much the average salary is in Scotland itself. So Scotland is still very, very affordable overall, and their market will be very robust in the next 6 months towards the end of the year. So they go on to say then, Zoopla, the affordability is improved relative to earnings as wages rise up to 7% over the last year, which we've just discussed in the very beginning, 7.8% actually. House pricing affordability on the house prices to earnings basis looks set to improve by 9 to 10% over 2023 as price registers modest falls and average earnings increase as well. When negotiations are settled, because some of them are still outstanding over the last couple of years for some of the unions. The UK house price to earnings ratio will be more in line with the 20-year average at the end of 2023 at 6.3 times. 6.3 pence is an excellent market. That is a really robust market. That's a stable market. So you have to bear that in mind. Should you be investing as a private landlord? The answer to that is the numbers work out. The answer to that is yes. We're going to talk about that more, Richard and I, tomorrow, about diversifying your lets. It's all about diversifying lets in different areas and different markets in order to maximise your earnings, in order to maximise, in order to de-risk most situations from volatile swings and maybe interest rates or occupancy rates or anything else, or rental values. Judging in Scotland, for example, by the rent increases being restricted by the Scottish Government. So that's why you would do that, and we'll talk about that more tomorrow for landlords and investors on our show at 9:30 with Richard and myself. So on a regional basis, Zoopla goes on to say affordability has improved the most in London. Who would have thought that? On a regional basis, affordability has improved the most in London. Hence, the price to earnings ratio will get into single digits for the first time in 11 years as house price growth has been low. Has been low since 2016. So London's actually house price growth has been low since 2016, which is good news because earnings has been a lot more, which makes it more affordable for people to buy in London than it did before 2016 itself. So Zoopla says they go and expect earnings to continue to rise faster than house prices again in 2024. I'll say that again. Zoopla expect the earnings and people's earnings continue to rise faster than house prices again in 2024, making it really affordable. Now, your salary, if that goes up by 7%, that's 7% of that salary is a lot more than a house price in terms of a mortgage. If you take that into account, if the mortgage only goes up 7%, the mortgage is a small proportion of what your salary is. So 7% on the mortgage and 7 extra on a mortgage and 7% extra on your salary are two different things. Mortgage is far lower than what that is, so it makes it more affordable overall then. So they said they expect the earnings continue to rise in 2024, including the measure further, especially in the southern of England, together with the mortgage rates at between 4 and 5% range, will support sales volumes closer to the long run average. Looking ahead, so this is where we're looking ahead now. Actually, Zoopla says looking ahead, they remain optimistic about sales volumes, the house price growth. More flexibility working will drive that number, and also demographic trends and the age and an aging population. A strong labour market, which is essential right now. We've still got a strong labour market. We're still sitting at about 4.3% unemployment. I mean, you know, economic terms, when you look at the economics of a full employment economy, it actually goes between 4 and 6% as classified as a full employment economy. In other words, everybody's in a job, because they take the 4% of jobs are unemployed and they balance them off against the jobs that are available. And the assumption is the people just need to find these jobs or retrain for these jobs, and that's everybody filled in jobs again. So that's why they call it a full employment economy, between 4 and 6% on an economic basis. So the aging population, strong labour market, and high immigration, that's clear, that's the state, despite the fact that they've done Brexit, will support movement and sales over the next 2 to 3 years overall. Quick look at graphs by their regions. This is actually quite interesting here. I'm going to zoom in on this. This is the region for the whole of the UK. We could zoom in. You can see there Scotland up 1.75%. Edinburgh seems to be the highest according to Zoopla at 2% increase. Nottingham next at 1.2, Birmingham 1.2, Sheffield 0.9, Manchester, Leeds, Liverpool, Newcastle, Glasgow 0.5 up, Cardiff 0.4 up, and then you get to the other side, whereas Leicester's 0.1 up, and then it swings over to Bristol, Oxford, Belfast, Southampton, Portsmouth, and you've got Cambridge, Bournemouth, and Aberdeen, all suggesting that they're lower in terms of house price growth. Okay, let's jump on finally and just cover the actual average house prices. According to Zoopla, they say an average UK house price, according to Zoopla, this is Zoopla's numbers. Now, they measure up to July, not August, because we've not got the final figures for them yet. But they can get enough figures and enough data for the July end. So they're saying 265,100. And then they're saying if you do the 20 city composite, which is like the big cities like Edinburgh, London, Glasgow, and you bring 20 cities, all the big 20 cities, that actual figure for the average price is 306,200. So it's clearly more expensive to live in a city than it is in suburbs or in rural areas. So Edinburgh is the highest, according. Well, actually, it's not. Let's look at London. £542,400 to buy a house in London on average, according to Zoopla. The least expensive, Glasgow, I think it is, according to this, you can see right now, 144,600. That's taking a lot of the tenement buildings into account. Yeah, Glasgow and Aberdeen, just behind, just in front of that, 145,600 in Aberdeen area. In terms of, now that's Aberdeen city centre. The periphery of Aberdeen is a lot more expensive when you go outside of the Aberdeen into the countryside. Okay, so hopefully that'll give you a good insight into the market overall, into the UK housing market and where they are. But as I said before, quite still a stable market. It's interesting to read these numbers and compare them, what Zoopla says, against what the Halifax says, and also the Nationwide say. Because Halifax and Nationwide spread doom and gloom. I have no idea why they get so much data which suggests that the house prices are dramatically down in price. But in actual fact, we don't actually see that as an estate agent. They're not that significantly impacted overall. The market's still quite stable overall, but I think it's down to the fact that the Halifax and the Nationwide have limited data. They should maybe pool the resources together and actually compared one set of numbers based on both of those. They'd have a more of whole of a market approach to it, and they'll probably come in with better statistics than what they have right now and they're producing. But they obviously just produce that because it's a soundbite that the news can pick up and it advertises their business at the same time. As I said, any further information, any further questions, please feel free to ask. Until next time, guys, and I'll see you tomorrow morning for our weekly show at 9:30 with Richard about diversifying your letting portfolios to make the best investment on returns. Bye-bye for now.